There is a moment in every financial era when the pattern that ends every era returns quietly, almost politely, as if reminding us that cycles don't break, they only reset. And this time, that signal is pointing directly toward 2025. It begins not with panic, but with silence, the kind of silence that precedes a structural shift. Markets look stable on the surface, yet beneath them, something familiar moves with slow precision. A repeating rhythm seen at the peak of dot-com euphoria, again before the housing bubble unwound, and long before that, during the steepest turns in financial history. This is the moment when curiosity rises, not from optimism, but from recognition. When people ask themselves, why does this feel like before? Because every grand cycle leaves fingerprints, and the world is starting to notice one of the most universal ones reemerge. Analysts call it a macro divergence. Historians call it the echo. But everyday investors simply sense the shift. Markets rising on thinner liquidity. Confidence soaring while underlying fundamentals quietly erode. A gap opens between narrative and reality, a gap that has widened before every major market cycle's reversal ever recorded. The signal is subtle. Valuations drifting upward even as corporate earnings flatten. Risk appetite increasing even as credit tightens. Investors rewarding speed instead of quality. These are not random distortions. They form a composite pattern, one that often indicates the psychological mispricing that precedes a systemic reversal. And it always starts in the same places. Debt pressure quietly concentrates, leverage expands under the surface. Liquidity becomes a mirror, reflecting belief rather than structure, and confidence rises at the exact moment fragility peaks. Most people never see this early phase because nothing outwardly dramatic happens yet. There's no headline, no crash, no public shock. Only the slow, rhythmic shift of sentiment from grounded caution to narrative-driven denial. A subtle drift, almost imperceptible, but universally present before every major adjustment. And so the uncomfortable question emerges. What if the signal returning now is the same one we ignored in every previous bubble cycle? What if the conditions aligning beneath the global economy are not new risks, but old patterns returning right on schedule? As investors search for stability, this quiet divergence grows. And this time, with cross-asset inflation, synchronized debt buildup, and a crowded chase for yield, the pattern appears sharper than usual. A reminder that the financial psychology shaping 2025 may be repeating more than anyone wants to admit. If today's atmosphere feels strangely familiar, it's because cycles rarely introduce new stories, only new characters. The underlying script often echoes across centuries, revealing how human behavior reacts to pressure in predictable, repeating ways. As historians like to remind us, financial history doesn't repeat, but the patterns do, especially when optimism rises faster than fundamentals. Consider 1929. The narrative during that era was built on innovation, productivity, and a belief in endless upward mobility. But beneath the enthusiasm lay a fragile structure, credit expanding faster than income, leverage accumulating quietly, and investors increasingly convinced that valuation no longer mattered. The result wasn't simply a market collapse, it was a massive wealth transfer, from those who believed the story too late to those who recognized the pattern early. Then consider 2008. People remember the housing crash, but the deeper trigger was psychological. Denial layered over systemic fragility. Once again, leverage grew silently. Once again, optimism drowned out caution. Once again, people justified risk with the idea that this time is different. But the behaviors were nearly identical to earlier eras. A collective insistence on ignoring early signals because the consequences felt too disruptive to acknowledge. When the correction came, it wasn't random. It was the natural unwinding of a pressure cycle that had been building for years. These patterns stretch even further back. Ancient empires experienced versions of the same dynamic. Expansion fueled by debt, followed by complacency, followed by a sudden loss of confidence when structural cracks could no longer be hidden. The currency debasement of Rome, the credit overextensions of the Dutch Golden Age, the speculative fever of early Asian trading empires, all different contexts, yet built on the same underlying psychological framework. In each case, the cycle followed a recognizable path. Pressure gives distortion, gives complacency, gives unraveling. The striking part is not the economic mechanics but the human response. People consistently interpret rising prices as proof of strength rather than signals of fragility. This is why every bubble cycle feels new, even when the underlying behavior is ancient. We mistake momentum for safety. We treat expansion as stability. And we underestimate how quickly confidence can shift when denial gives way to recognition. Today's environment mirrors these past moments with uncomfortable precision. Multi-decade debt expansion, speculative enthusiasm in layered asset classes, and a growing disconnect between market narratives and structural reality all recall the same recurring rhythm. What we see in 2025 is not an unprecedented danger, but a familiar arrangement of ingredients that has appeared before every major systemic realignment. The message across centuries remains the same. When psychological optimism outpaces structural resilience, cycles reset. And when patterns recur at this scale, they rarely fade on their own. To understand why these cycles return with such precision, we need to step away from headlines and look deeper into the structural and psychological mechanisms that silently shape every financial era. Markets don't collapse because of one event. They collapse because pressure accumulates faster than awareness. And that pressure follows a consistent internal logic. Debt gives denial, gives cascade, gives correction. At the core of every major turning point is a simple truth. When debt grows faster than income, the system becomes dependent on belief. And belief, unlike capital, can disappear instantly. In the early phase of a bubble, optimism feels rational. Rising asset prices reinforce confidence, and confidence reinforces investing behavior. This feedback loop creates the illusion of stability. But what most people overlook is the distortion occurring underneath. Valuations detach from fundamentals. Risk becomes mispriced, and liquidity appears abundant only because everyone agrees it should be. This is where behavioral finance reveals its quiet power. Investors rarely act on objective data. They act on collective mood. When markets trend upward, people assume others know something they don't. This herd-driven confirmation strengthens what economists call momentum belief, a state where the investor mindset becomes more narrative-driven than analytical. The mechanism evolves in 4 predictable stages. Cycle pressure debt expands. Leverage increases and structural vulnerabilities multiply. Yet these early signals remain hidden because nothing visibly breaks. In fact, rising prices make the system appear healthier, masking fragility beneath apparent growth. Behavior distortion. Investors begin rewarding speed over quality, speculation over judgment. Each upward move strengthens the belief that risk is manageable. The system becomes more psychologically driven than structurally supported. This is when mispricing begins, not due to corruption or malice, but due to collective overconfidence. Systemic fragility. A small shock, liquidity tightening, credit stress, unexpected defaults, reveals that the entire structure depends on perfect confidence. Once this confidence wavers, fragility spreads through interconnected nodes, banks, funds, consumers, and leveraged speculators. The system isn't collapsing yet. It's merely showing the stress it had all along. The correction. This is where the cascade emerges. Not because of panic, but because the system can no longer sustain its accumulated promises. Prices adjust downward to reconnect with fundamentals. This adjustment feels sudden, but it is simply the end of a cycle that has been building quietly for years. The most unsettling part is how familiar this mechanism is across time. Debt expansion, narrative distortion, misplaced confidence, these are not modern problems. They are enduring patterns baked into the psychology of markets. Every bubble cycle uses different assets, different technologies, different catalysts, but the emotional architecture remains the same. And so when we look at today's environment, cross-asset exuberance, escalating leverage, thinning liquidity, we are not seeing a mystery. We are seeing the same mechanism that has always governed systemic reversals. The same psychological incentives, the same structural misalignments, the same slow drift from rational pricing to narrative pricing. The mechanism is not new. What's new is how interconnected, leveraged, and sentiment-driven the global system has become, which is why the pattern forming now feels both familiar and amplified. If earlier cycles revealed the blueprint, today's environment shows the full-scale model, bigger, faster, and more interconnected than anything previous generations ever faced. The same structural pressures are present, but now they operate through digital markets, instant sentiment shifts, and global liquidity pipelines that react within seconds. The quiet, recognizable rhythm of a maturing bubble is still there, only amplified by technological acceleration and years of compressed interest rates. The signs are subtle, but not new. We see valuations expanding into thin air while corporate earnings plateau. We see household leverage rising quietly behind the facade of consumption strength. We see institutional investors chasing performance rather than fundamentals, mirroring the same psychology that existed before every major realignment. But now the system contains an additional layer: AI-driven allocation. Machine learning models trained on a decade of artificially low volatility reinforce behaviors that only work when liquidity is abundant. Their logic loops back into the market, pushing prices higher, tightening correlations, and deepening the divergence between economic reality and asset pricing. This is why many analysts describe 2025 not as a normal turning point, but as a convergence of unresolved pressures: multi-asset leverage, global debt rollover, liquidity thinning across key funding markets, and a rising belief that the next downturn will be shallow, an assumption that has historically preceded deeper resets. We see early tremors in the bond market where refinancing stress is beginning to surface. We see credit tightening around small and mid-sized businesses, often the first sign that the real economy is losing breath. And we see the emergence of a dangerous idea that central banks can solve structural fragility through narrative alone. But narratives don't cancel cycles. They only delay recognition. This is where the term market crash 2026 quietly gains relevance, not as a prediction, but as a psychological marker. Investors anchor to dates because uncertainty feels intolerable, but cycles rarely obey calendars. Instead, they respond to the alignment of liquidity stress, structural imbalance, and behavioral distortion. And right now, those elements appear to be moving in sync across the global economy. Meanwhile, the average investor absorbs information through fragmented digital channels, short clips, algorithmic feeds, and optimism-heavy commentary. This creates a subtle disconnect. People feel informed, but not necessarily grounded. Their attention is captured, but their understanding is shallow. In past cycles, this kind of surface-level awareness has often contributed to late-stage mispricing. Underneath all of this lies a deeper structural issue. The debt bubble hasn't been resolved, only rolled forward. Trillions in sovereign, corporate, and household debt continue to pile up, each rollover tightening the system just a little more. Inflation cools one month and returns the next, signaling not stability but an overstretched framework struggling to rebalance itself. Shadow banking channels expand quietly. Liquidity pools thin. Banks reduce duration risk by passing it through hidden corridors of the financial system. Each of these pressures acts like a small, steady weight, and eventually, the structure must adjust. This is not an alarmist narrative. It is the same dynamic we see before every economic reset: a long stretch of complacency, followed by subtle early signals, followed by recognition. And now, with cross-asset optimism outpacing structural resilience, the parallels are becoming increasingly difficult to ignore. As we stand in the middle of this slow-moving divergence, the question is no longer whether the cycle will turn, but how many people will recognize the shift before the adjustment forces clarity. If the structural pressures explain how cycles break, the psychological patterns explain why people keep walking into the same collapse. Every major financial era ends not because the data was unclear, but because the human mind is wired to misread slow-moving danger. The mechanisms are ancient. The behaviors are instinctive, and the outcome is almost always the same. At the center of every bubble lies a simple contradiction. People want certainty in a system built on uncertainty, so they construct narratives that feel stable, even when the underlying structure is not. This is where financial psychology becomes the invisible architect of every boom and every correction. Investors don't respond to numbers. They respond to feelings disguised as logic. When markets rise, confidence becomes self-validating. When prices drift higher, people interpret it as proof that their judgment is sound. This reinforces what many call the wealth mindset. But in late cycle phases, it often becomes a fragile version of that mindset, built on expectation rather than understanding. The core biases that repeat every cycle. Normalcy bias: people assume tomorrow will look like today because it feels safer. This is why early warning signals rarely trigger action. The mind favors stability even when stability is an illusion. Denial. This is not emotional denial, it is cognitive denial. A quiet refusal to confront uncomfortable information because the consequences feel too heavy. Investors tell themselves the system is stronger than it is. They minimize debt risk. They ignore structural warnings because accepting them would force a psychological reset long before the market delivers one. Overconfidence. Once prices rise long enough, even cautious investors begin to believe they understand the game. This is not arrogance, it is pattern misinterpretation. People confuse prolonged calm with permanent safety. We've seen this in every cycle. From the roaring 1920s to the housing boom of the mid-2000s to the liquidity-fueled expansions of the 2010s. Herd instinct. No one wants to be the first to step away from the crowd. Social consensus becomes a substitute for independent judgment. This behavior is ancient. Tribes survive by staying together, but markets often punish that instinct. When everyone moves in the same direction, the system becomes vulnerable to even small shocks. These biases shape not only individual investors, but entire cultures of decision-making. Institutions, funds, households all fall into the same psychological traps because the incentives are aligned toward short-term reassurance rather than long-term resilience. This explains why quiet investing often outperforms exuberant investing. Not because it is smarter, but because it is less reactive. Less entangled in the emotional storms that form during late cycle phases. Less influenced by the narratives that inflate bubbles and intensify their endings. The paradox is clear. Markets evolve. Technology accelerates, information becomes abundant. And yet, the underlying behavior barely changes. Markets change because people don't. This is the fundamental truth beneath every historical collapse, every modern mispricing, and every approaching realignment. In 2025, the psychology looks familiar. Confidence elevated beyond structural support. Risk-taking justified by backward-looking assumptions. Narrative strengthened by collective attention. Not fundamentals, early signals dismissed because recognition feels premature. This is the silent setup, where emotional patterns converge with systemic pressure, forming the conditions for the next large-scale wealth transfer. Not intentionally, not maliciously, but predictably. Because when cycles mature, psychology becomes the invisible tide pulling the system toward its reset. As we reach the end of this cycle narrative, one truth becomes impossible to ignore. Every era believes it is different, yet every era leaves behind the same unmistakable fingerprints. Debt builds quietly. Confidence drifts upward. Sentiment outpaces structure. And somewhere between optimism and reality, the system begins to lean just a little too far in one direction. That is the moment we inhabit now, a suspended state where the surface looks stable, but the underlying weight grows heavier by the month. Not a crisis, not a crash. Just the quiet tightening of a long-formed pattern. Across the global landscape, we see the same recurring signs: liquidity thinning at the edges, valuations stretching into narrative territory, and cross-asset complacency hardening into belief. These are not predictions of catastrophe. They are the same soft signals that appear before every major economic reset, marking the subtle transition from expansion to rebalancing. And within this shift lies the mechanism generations have witnessed but rarely recognized in time: wealth transfer. Not in the dramatic sense of panic or collapse, but in the calm, orderly repricing that always follows periods of structural imbalance. The transfer happens silently, systematically, as the system corrects for years of accumulated distortion. This is why understanding cycles is less about forecasting the future and more about recognizing the present. Patterns do not warn us through noise. They warn us through repetition. And the repetition we see now in behavior, in structure, in psychology mirrors the late stages of every major financial turning point. Yet the message here is not fear. It is clarity. A reminder that awareness is the most stabilizing force available to anyone navigating uncertain terrain. When the psychological, structural, and historical layers align, the goal is not to anticipate disaster, but to observe the shift with calm attentiveness. The cycles that shaped past eras are the same cycles shaping this one. Their mechanisms are quiet, predictable, and deeply human. And while the future will unfold in its own rhythm, the patterns guiding it are already visible for those willing to look beneath the surface. That's why understanding the psychology of collapse isn't fear, it's preparation.